So the question about how we are currently positioned in the market, we tend to invest for the long haul. So we want to have a balanced asset allocation to make sure that we're covered. And currently at this point here, we're neutrally invested. So if we look at a 70-30 portfolio, 70 global equities, 30 fixed income, the fixed income portion of the investment is actually only 20% in traditional, but it's 10% in alternatives. And the reason for that alternative slice is when you're in a raising rate environment like we are now, you get negative returns. We had a lot of those from 1950 to 1980 when rates were going up. And you want to have some alternatives that I like to say live between the wall and the wallpaper. And if they can be a nice complement, not a replacement, but a complement to the fixed income side. And then on the equity side, we're overweight on the US, even though the US is more expensive. It still is the cleanest shirt, to use a saying that's been used before. And then between growth and value, we're 50-50 between growth and value. I know that growth is out of vogue when people are saying rates are going higher, but we're also in a period where there is a lot of productivity enhancement going on. That all plays right into technology. The frequency with the changes that we would be making to our portfolio, they vary according to market conditions. We first of all have investment committee meetings on a weekly basis, and then we're monitoring the portfolios on a real-time basis. And it really depends. Each position we have has an upside price target and a downside price target. Those price targets are reevaluated when there's new fundamental information that comes in. So there's some periods when you have low volatility when you're going to have no turnover in your portfolio. 2020 with COVID, we had 50% turnover in our portfolio. This year, volatility is back on the rise after 2 years, so you're seeing increased turnover in the portfolio. But the one thing I would mention here is the tricky thing when you make a sale, it's a two-step process because you then have to reinvest or put into a new asset class. So you've got to really put on your court vision goggles. So concerns that exist in the market that we see from clients, one of the biggest things is clients are continually more fearful of the left-hand unintended or tail risk as opposed to the right-hand side where it's the upside in the market. And I always like to remind myself and the clients that fear is temporary, greed is permanent. And I know it's kind of a straight up crass statement, but what it really brings into perspective is that particularly if you've got clients that are, under the age of 50, you're saying you've got a long haul to invest in the market. If you believe in technology, you believe in capitalism, you want to be invested in the markets. And particularly now when you have inflation going on, during the 70s, the only inflation hedge that you had were hard assets like real estate and equities. Fixed income lost on a real return environment. So we've been in business now for 20 years. Main Management is based in San Francisco. It's partner owned. We've got 18 employees and partners. We've got $2.5 billion that we run for assets under management and assets under advisement. And I would say the why on Main Management is we believe that it's a client-centric, exceptional service, and we believe that clients should get to keep more of their investment returns. So we're very much focused on the why and the service for the clients. So I think the first piece is after 2 years of COVID lockdown, it's phenomenal to see everybody kind of back out in the wild again. People, the whole COVID fear has receded. So as much as we like to believe that, stay at home, work remotely is great, we're very, we're very social animals. And so it's nice to kind of get back out and see people again, see faces that you haven't seen in person in 2 years. So I think that's a phenomenal thing. I think the other thing is the networking aspect. When you're able to kind of network with your colleagues, you all have common goals because we're all fighting for the same thing, for better client outcomes and being able to better service clients with solutions for problems that they have. And this is a perfect venue to be able to achieve that. Yeah, there have been a couple really good ones there. There is a model portfolio delivery session that I'm very excited to sit down and listen to, because I really believe, again, for access for advisors and for their clients, model delivery is a key piece. The other thing that's very interesting is anything using alternatives, again, to complement that fixed income where you've got negative rates of return. I think that's very important. It's very educational for advisors to be able to learn about that and offer that up for their clients. We think that covered call writing makes a lot of sense because you can have an underlying global asset allocation, so you get the return stream on that. You get the dividends, which are very predictable coming off of it, and then you can do in-the-money covered call writing, so you cap your upside, but you're providing a lot more downside protection for the client. So I think those are very clear and transparent, and they make sense for the clients. The strategist channel at ETF Trends is a very important part of kind of our whole outreach and our messaging to clients, and we think that it's a phenomenal resource for advisors to be able to go on. There's some phenomenal strategists that have their information, they have collateral, they have content. It's a great resource that if people are not using it, they should clearly go and use it. So how do we work with State Street? State Street is obviously one of the top 3 providers in the ETF space with, the top 3 providers have 80+% market share. State Street has an incredible breadth of product. We're agnostic when we look at the solutions that we want to use for our clients there. But as it turns out, State Street they've got cheap beta, they've got active products that make a lot of sense, they've got in every single asset class, so they are pervasive, and they're also, I want to give a shout out to them, they're really good at servicing their products that they have, not just putting them out there, but servicing them and providing more solutions to help out advisor or RIAs like ourselves and then advisors. So where do I see the ETF industry going from here? I think it's continuing to gain market share from mutual funds and will continue. As a quick side note, we have a legacy mutual fund that we're in the process of converting into an ETF this year. And it's become the right time to do it. Before it wasn't, which is why we built that. But I still think that, again, I look at ETFs with their transparency, their liquidity, their low cost. It's a better vehicle than mutual funds, and I continue to see more mutual fund legacy products that'll be converted going forward. So I think what I would just say is again, COVID kind of taught us all that you kind of reevaluated what was important to you. Obviously, family is extremely important, health is very important, but work and social also needs to be balanced inside of there. So it just made me be much more appreciative of the things I have, and when you don't have something, realizing don't take it for granted.